Yo, what is up, everyone? My name is Dom, and we're here to talk about unusual options activity. Alright, let's kick it off with the disclaimer. So, this video is for educational purposes only. Statements made in this program here are solely the opinion of the show and are not a specific inducement to make an investment. One must perform their own due diligence and realize that all investments carry risk. There's no guaranteed profit. Alright, everyone. First one I want to bring up is the XLF. Now, this is the Sector Spider a bank ETF. So, this is a collection of banks in the S&P 500. Now, this might be a play on interest rates here. You know, as that yield curve steepens, you know, banks are able to make a little bit more money off of loans here. So, you know, this is kind of, for me, a little bit of a hedge against raising rates here. So, as you can see here, there's some huge volume in these March 26th 34 strike calls. There's definitely some institutions stepping into there, and if you come down to the time and sales here, you know, you'll see right here that somebody was actually doing a vertical spread. They're buying these May 21, so this is a different one here. So we're looking at these May 36 and May 39 strike calls. Now, if you come down to the time and sales here, you know, you can see right here that someone is coming in and buying these May 36 strike calls, and they're shorting the 39 strike calls against it. So what they're doing is they're buying the 36 strike call, they're capping their profits off, and they're shorting the 39 strike. So remember, this is a vertical spread here. You're buying one strike in the same expiry month, and you're selling a higher strike in the same expiry month, 1-to-1. This person got 20,000 shares of the 36 call, sold 20,000 contracts of the 39 strike call. And remember, with the vertical spread here, so they paid 67 cents for this 36 strike call. They collected about 14 cents on this 39 strike call, because you're buying one option and you're shorting another option, so you're collecting premium on the short option, you're paying out on the long option. They're going long the 36, going short the 39. And remember, on a vertical spread, they paid 67 cents minus 14 cents. So whatever that equates out to be, I think 53 cents, and the maximum profit you can make on a vertical spread is the difference between the strikes, because buying the 36 call gives you the right to buy the stock at 36, selling the 39 call gives you the right to sell the stock at 39. So 36 to 39 is $3 times 100 is 300 bucks per option contract. So the width and the strikes, 36 to 39, that's 3. So that's how that works. It's a little bit of an explanation for y'all. So as you can see here, the regional bank ETF has had a huge run here. You know, this thing has underperformed for many years. You know, I keep bringing up on this channel, you know, the rotation of value here, rotation of value. Now this thing has underperformed. Oh, I thought this was the pre-pandemic high. This looks like it's 2008. This thing has been dead money since 2008. Came up, hit resistance, came back down, came up, hit resistance again pre-pandemic, and then it just blew that out of the water. You know, resistance was at about 31. Now we're sitting at about 35. I think I do not own the XLF because I already have some individual stock bank exposure. But you know, this would be a good one to jump on in. You know, it's just kind of a little overbought right now, so you know, maybe let it cool off. But yeah, that's totally up to you guys to do your own due diligence on that one. So next one I want to bring up is JD. From my opinion, they just had earnings on March 11th, I think it was. They had great earnings growth, great revenue growth. I think about 30% top and bottom line growth. Now JD trailing 12 month earnings sells at about 17 times earnings. I think if they have like 15% earnings growth, and they've averaged a heck of a lot more than that. They did not provide guidance, by the way, sales guidance. So this is kind of just a projection here. You know, that means, you know, if they grow their earnings year over year at about, you know, 15% or so, I think they average about 30%. You know, great growth. And you know, if they're able to pull off that at least 15% earnings growth, you know, that puts the stock, you know, trading at a very reasonable, very undervalued level on a price to earnings ratio here. So as you can see here, I have a position in the September 17th 90 strike calls. There are some nice buy-in in the September 17th 80 strike calls. You guys can go down to the time and sales and check that out. I think somebody put down multiple millions of dollars just in the time and sales down below. Now this thing has had a huge run. This is a China internet stock. Now, I like somebody who's buying the dip here. JD traded up to about 109 on February 15th, traded down to about 84. Today it was down a little bit. So, I saw people buying those September calls. I like people who are buying the dip. I like people who are going out many months. I don't mind paying the extra money, as I say all the time, to, lower my risk just by going out further and giving myself more time for this trade to work out. So, thanks to everyone who's been subscribing. I really appreciate it. Make sure to leave a comment down below if you got any questions, and we'll see you in the next one, everyone.